Great to be at your wonderful conference. It's too bad we couldn't be live, but this is a pretty good substitute. Uh, First, I'd like to thank Professor Athanasakos and Ivy. I think they do a tremendous service to the value community. A big round of applause to you from all over. Thank you for everything you do for us. Uh, what I would like to do, like the subject of the talk is from Graham to Fisher, and uh, last year, 2020 is a year that most of us would like to forget, and probably even half of 2021 is appearing to be the same way. Uh, but it was actually an unexpectedly amazing year of growth and learning for me, and I think it was a period of renaissance. So I'd like to share some of that with you and talk about that. So there's a book coming out in 6 days, and the book is called Richer, Wiser, Happier, and it's written by William Green, who is a former journalist with Time and just an excellent journalist and writer. And I think he did an incredible job. It took him several years to write the book, and I think you guys would love to read it. Uh, I got a galley copy of the book maybe close to about 10 months ago, and of course, there's chapter one about some yo-yo which you can skip, but chapter six, to me, chapter six was the most eye-opening chapter, and chapter six in many ways was transformational for me. So chapter six uh, was about Nick Sleep and his partner Case Zakaria, and they ran the Nomad Investment Partnership from 2001 to 2014, about 13 years or so. And I've actually known Nick for close to 2 decades. So we've been friends for a while. But I mean, he lives in the UK, and we don't interact that much. And what I had not kept up with Nick was that he had been on this uh, value investing, learning, and growth journey, and he got to what he considered the pinnacle. And I'd say I would be mostly in agreement with that. And so that chapter had a number of uh, eye-opening insights, and it led me to uh, hit the reset button in many ways about how I thought about investing. So for the longest time, the simple math I used to use on investing was that if you bought a dollar for 50 cents or 40 cents, and you just patiently waited for that dollar to be recognized as being worth a dollar by market participants, then you could earn a pretty handsome rate of return, even if that pie did not grow. So basically, if convergence from 50 cents to a dollar took 3 years, then you would end up with a 25, 26% annualized return. And if it took a couple of years, then it would be kind of mid 30s. And all of that, of course, is very acceptable. But also, what we have is we have investing mistakes. So probably 40% of the time when we make investments, they don't go the way we want. So not everything doubles like the way we expect. And so some businesses we'll actually end up losing money on, some will flatline, and some will deliver much lower returns and all of that. But when you mix it all up, the end result is still very acceptable, and that's why value uh, investing works. And that buying a dollar for 50 cents. Uh, was a bedrock for me, and it's the bedrock for Ben Graham, and it's the bedrock of what we've all learned and used. Um, Nick posed some interesting questions. Uh, so he said that if you looked at a business like Walmart, which went public about I think 51 years ago, and so in one of his last emails to me, he said that um, the only people who held Walmart stock for that entire 51-year period was the Walton family. And uh, and there are, as far as I know, no public investors who have held the stock for 50 years or 40 years or even 30 years. And if you didn't recognize Walmart was an exceptional business in 1970, you could have recognized that by 1980, or you could even recognize that by 1990. By that time, the company had several decades of history behind it. Uh, but in spite of all of that data, uh, public investors did not hold the business for an exceptionally long period of time. And the second question that Nick Sleep asked was that if you were a portfolio manager, say in the mid '80s or maybe the early '90s or somewhere around there, and you held Walmart stock in your portfolio, what exactly were the factors that led you to eliminate that position? And he asked a kind of I would say, a mirror question to that, which is that in the '80s, early '90s, if you held Kmart stock, uh, what caused you to hold on to that stock and not sell it? And then Nick also pointed out to me, and I think he does this in his letters as well. And by the way, now he has made those letters public. So I think if you go to Google and just enter Nick Sleep Nomad letters, I think they'll pull up, and those are a exceptional read. I think that reading those letters and then in conjunction with William Green's book, I think is an incredible growth opportunity. So Nick did us a great favor by making those letters public. And so then the other thing that Nick was saying to me in an email, but he also says this in his letters, is that um, Walmart was a company that in the '70s you could have paid 150 times earnings for the business, and from then till now earned a double-digit annualized return with no taxes due for 5 decades, and other than for the dividends. And so you could have paid what would have looked like a ridiculous price for the business, and of course it did not trade anywhere near 100 or 150 times trailing earnings. So it was available at a fraction of that. And of course, I would say the opposing view would be that retail is really difficult, and the landscape of retailers uh, who are no longer with us. I mean, the graveyard for retailers is overflowing. So it is the exception as far as retail goes who actually makes it. So I'm not particularly concerned about retail and those aspects of it. What I was trying to look at is that was there a different and maybe better way to approaching investing other than just this, buy at 50 cents and a dollar. And then last year, I also read another book, and I think this book is exceptionally well written. And it was written, I think, close to 50 years ago, about 49 years ago. And it is called 100 to 1 in the Stock Market. And this is written by Thomas Phelps. And Thomas Phelps actually is a exceptional writer and a exceptional journalist. He used to be a writer for Barron's and such. So he's a very bright guy. He's passed away, but he did a tremendous job with that book. So even though that book is 50 years old, it's still very relevant, and the writing is still very fresh. And there's a bunch of interesting kind of uh, areas in the book. Like he's got conversations with Joe Kennedy, who was the founding commissioner of the SEC and the father of John F. Kennedy. So there's some interesting tidbits in there as well. But Phelps basically pointed out that basically if you were a very patient investor and held on to these businesses for, in some cases, many decades, there were hundreds of them that would have delivered 100 to 1 or better returns for you. And so the framework shift I made was not so much to look at hunting and finding 50-cent dollar bills, but to look and try to find businesses that could be a 10 bagger or preferably a 100 bagger. And of course, the 100 bagger might take a couple of decades, but that's perfectly fine. And there's a quote I'd like to share with you, which is from the Upanishads. And the Upanishads are these ancient Indian texts that were written more than 2,000 years ago. And of course, they have a boatload of wisdom in them. But for our purposes, and I'm not sure they had the idea of making investors wealthy, the writers of this quote, but I think it works for us. So the quote translated is, "As is your desire, so is your will. As is your will, so is your deed. As is your deed, so is your destiny." And then they bring it all together and say, your deepest desire is your destiny. So what I have found, by the way, I found that quote to be true for several decades for me personally, because I think that's just the way the world works. But I think it's true for many, many people, for most of us. So if we truly, truly want something and we are singularly focused on it, and we do everything in our powers to make it happen, it's going to happen. So when I focused on 50-cent dollar bills and I kept going through stock after stock after stock, hunting for those mispriced bargains, of course I'm going to find them. And if I were to set the parameter as I want a 40-cent dollar, I'm going to find those too. If I said I want 30-cent dollar bills, I'm going to find those too. So even if you were to set the parameters really tight, where you say, I'm only willing to pay 10 cents on the dollar, for example, as long as you were singularly focused on it, it would happen. I mean, I think there were investments that Li Lu made when he was a student at Columbia. So when Li Lu came as a poor Chinese refugee to the US and he joined Columbia, he didn't have any money. And, so he was on full scholarships, etc., and student loans. And so he invested the float of those loans. So, he might get $10,000 or $15,000 a few weeks, a few months before he actually has to pay the money. And he would, invest it. And from that student float that he had, by the time he finished at Columbia, I think 5 years later, or maybe 4 years later, he had over $1 million. And so he never took a job. He never worked for anyone because he was, from his point of view, uh, doing quite well. And in that 4 year period, I think if you were to talk to Lilu, there were some Russian company he found which was, went up 100x. So there were unusual things. So whatever you set your baseline to be, if you set it to be 70 cent dollars, you will find those. So I had set my baseline for more than 25 years at this 50 cent mark, and if I could get 40 or 30 cents, that was kind of icing on the cake. So I've changed that. I've said, okay, that's so 20th century, and so my my hunt now is for 100 baggers. And so when you shift the focus from a 50 cent dollar to saying I want 100 baggers, kind of different things become relevant because what you're when I was looking for 50 cent dollars, I didn't really care that much how much that pie grew. Uh, I mean, it could be that I was paying 60 cents for the current pie, and there would be some growth in the next 2 or 3 years, and the pie might become 25% larger, and I'd still get my double, and life is great. Uh, but when you put on a lens which says that I want to focus on 10 baggers or 100 baggers, the equation changes and what you look for changes. So, for example, if I looked at a business like Amazon, which is a wonderful, exceptional business, and of course, uh, Nick Sleep was very smart to have recognized Amazon very early and understood many things about its incredible moat before most of us did. And in fact, one of the reasons he shut down the fund was that he had made a significant investment in Amazon, and it might have been a fifth of the fund in terms of invested capital, and then of course it was going up in value and becoming a larger and larger portion of the fund, and the British regulators questioned the the risk management and the portfolio management, two very alien concepts to Nick Sleep. And I think that was one factor. But his partner and he kind of looked at each other. They were managing about 3 billion. They had become wealthy beyond their wildest dreams. They did not want to sell Amazon. They did not want to take that concentration down. And so what they said is, we'll return all the capital. And they did. So in 2014, they wrote to the investors and said, we are kind of hanging up our boots and retiring. And they were in their, kind of 40s at that time. And, here's your capital back. And Nick Sleep basically told his investors that I am going to take my proceeds and put it into three businesses. And the three businesses he put his money into, all his money into, were Berkshire, Costco, and Amazon. And in 2014, Amazon was around $300 a share. And so even if you ignore what happened to Berkshire and Costco, if Amazon was a third of the pie, that would have been an incredible home run, while having the broker starve with no commissions. And he told his investors when he returned the capital that you don't need to pay us any fees. You don't need to read our boring letters. Just buy these three stocks with the capital we're returning to you, and warm regards. And of course, the institutional investors who they gave this money back to, in fact, I got calls from some of them. I remember one endowment that called me and they were kind of freaked out. And they're telling me, oh, do you know Nick Sleep is returning all the capital? I said, yeah, but he told you what to do. He told you just take the money and buy the three stocks. And they said, well, our mandate doesn't allow us to buy individual stocks. So then I said to them, would you like me to set up a separate account for you where I'll buy those three stocks and then you can pay me ridiculous fees? So these are the kind of conversations that go on with our enlightened endowments and institutions. And needless to say, they did none of that, and they're probably grazing at their navel right now, wondering why they didn't do so well. So anyway, Nick's point was that um, an investor in Walmart or an investor in Amazon or Costco or Berkshire should have the framework which the founders or the owners of the business have. So the Walton family basically is not interested in selling Walmart stock. And they just held it throughout. They held it even after Sam Walton went away and even after the next generation has started going away. So it's been a multi-generation hold. And, the same thing applies to Berkshire Hathaway and to Amazon. Now, one of the things that happens that if you are exceptionally good at this, if you do really well at this, and you're running a pool of temporary capital, like Nick Sleep was running, what is going to happen is one stock is going to become 90% or 95% of the pie. And most institutional investors and money managers would choke at that. They would never allow that to happen. And I think that's ridiculous. So what I think should happen is that once you're starting to get concentrated, don't let new investors come in. So kind of freeze the capital and broadcast loud and clear to everyone that fasten your seatbelts. We're not selling these positions. We're going to be holding on. And if you don't feel comfortable, you can exit. But we're not going to cut the flowers and water the weeds. And going back to the Upanishads, I shifted my thinking to 100 baggers. And so obviously, the Amazons and Apples and Googles of the world, if you do 100x from their current multiples, I think it would require quite a stretch of the imagination to get to a point where you thought it was high probability that even in 20 years you would get 100x from here. So certain things. So Amazon probably is a great investment, but at least for me, it's not 100 bagger material. I mean, it was 100 bagger material. I was too dumb to take advantage, but I don't think it's happening from here in the next 2 decades. And so once you shift that framework, different things come into focus. And so, for example, in 2019, which is before my period of enlightenment, I'd been visiting Turkey several times, and I encountered this business in Turkey where the market cap was 19 million and the liquidation value was somewhere between 300 million and a billion, somewhere in that range. And of course, I tried to buy every share I could. And we ended up investing $7 million and getting a 1/3 stake in the business. And so my framework at that time was that this is a good business. It's the number one warehouse operator, lots of recurring revenue, number one operator of private freight cars in Turkey, and a few other very nice businesses. Very good recurring revenue businesses, very good operators, and they created tremendous value over the years. So I said, we'll hang on and we'll see kind of at what point there's a convergence between, our equity position and intrinsic value. And when we get to intrinsic value, we can unload and move on. Well, that framework has changed now. So It's been close to 2 years that we've held the stock. And now my thinking is that, yeah, so it's worth 300 million to a billion when we bought it. Um, could it be worth 2 billion at some point? Because if it gets to a 2 billion value, when we were buying it, it was a 20 million or 19 million market cap. That's a 100 bagger. And a 300 or 500 million or $1 billion business today, getting to 2 billion isn't that hard. And it isn't that hard in 10 or 20 years. So my take now with that business is set it and forget it, And the way we think about that business, the way I think about the whole that portfolio position is it's not a portfolio position. It is a business we are a partial owner of. We are a passive owner. We are a junior partner to the family that runs it. We have no desire to tell them what to do or how to do things. They are doing quite well without any input from us. And life is great. So we just kind of watch from the sidelines. So the simple math here is there are just two things that matter. The first thing is a periodic check on is the business getting better? And of course, business doesn't go up in a straight line, so you have to take out the noise. But in general, if you're seeing that the moat is intact and the moat is widening and deepening, then forget about the valuation. Then the second part, which is the valuation, is like I just said, forget about the valuation. If it gets egregious, not overvalued, but egregiously overvalued, then you can take a look at it. So, for example, if I think this Turkish business is worth 2 billion at some point, and the market is pricing it at 20 billion, for example, we would probably not be a shareholder at that point, or even much before that point. But it would have to get to significant, egregious overvaluation to doing that. And so the third part of this journey is that if I can find these 100 baggers, or at least companies that look like decent candidates, that over a 10 or 20 year period they could get there, then we become a portfolio becomes a museum, and we become a collector of these 100 baggers. It's great from a tax point of view because we just sit on them. And the idea is that we only really need one. I mean, the Turkish business might not do it for us because it was such a small investment. We put like a little over 1% of the portfolio into that. But if I could make a $50 million bet, and at some point it became a 20, 50, 100 bagger, it would become a very significant portion of the portfolio. And we don't really need the rest of the portfolio to do that much. So the rest of the portfolio is still not slouches. So Berkshire has underperformed the S&P for Nick, but it's still gone up in value. Costco probably has matched it over this period. But it doesn't matter. It's fine. Those two have added value. And then you have one with kind of high octane returns. And so that has worked out really well. So these are some of my blessed COVID learnings. So in many ways, I think maybe I should be grateful for COVID because it put an end to my travel, gave me more time to contemplate my navel and try to understand what's going on. And I told Nick that as soon as international travel opens up, I'd love to have dinner with him. And he's excited about that. So that would be my first trip leaving the US will be to break bread with Nick and Zach, and that'll be great. So thank you, Professor George. I think it's delighted to be here.